IT shares were under pressure on Monday after IT major Accenture delivered mixed results for the first quarter of FY23, coupled with cautious commentary on client spending. Infosys and TCS shed 1% each in Monday's firm trade, while Wipro was down 0.2%. Coforge and Persistent Systems were the top drags within mid-caps, and the Nifty IT index was the sole sectoral loser. Accenture delivered 15% YOY revenue growth in constant currency terms, exceeding expectations. However, it pegged the next quarter's revenue below analyst estimates, leaving the full-year revenue growth guidance untouched at 8 to 11%. This is reportedly the first time since FY17 that Accenture has not upgraded its full-year guidance after the first quarter. Analysts believe that the unchanged guidance compared to a 26% growth in FY22 is indicative of softening of demand for IT services and growth moderation for companies. We maintain our cautious stance on the demand outlook for the IT sector and think consensus revenue growth estimates for FY24 may see downward revisions. Aniket Pandey of ICICI Securities adds that the industry's lower employee addition further reflects the slowdown in revenue.
So Accenture, in spite of delivering growth on its higher end of estimates, they have still maintained their FY23 YOY CC guidance, right? And this is in spite of strong growth coming into last quarter also, okay? But if you look at closely at this number, right, I mean, this is basically in second half FY23, the revenue growth guidance just implies a growth of about 5.6 to 9.6% YOY CC, okay? Which was almost around 25% YOY CC in second half of FY22, right? So growth is normalizing very aggressively from 25% YOY CC. It is coming down to 5.6% to 9.6% CC. So I believe from here on there would be a revenue moderation coming in entire IT ecosystem. Okay, and Indian IT stocks are more sensitive to revenue growth as compared to EPS growth. So we believe that the sector is still trading at around 22.5 times. Okay, which is almost about 30 to 35% premium to its pre-COVID multiples. Okay. So yeah, there are more headwinds or risks to the revenue estimates on the downside than to the upside at this present scenario.
Accenture has also signaled rising caution among clients, which are now shifting to large cost transformation deals over smaller projects. This positions larger IT firms more favorably than small-sized firms, according to Jefferies, which remains selective in the sector. On the other hand, Accenture posted a sharp decline in attrition to 13% vis-a-vis 20% in the preceding quarter, boosting the margin outlook for domestic IT players.
One needs to understand, right, we are entering into a planned recession environment, okay? So this is not as what we can compare with 2008, 11 and even what happened in COVID, okay? There are no big uncertain risk on table actually, right? Those events were completely uncertain in nature. This is a planned recession, right? So clients or vendors are also planning according to it actually, okay? So my sense is that, I mean, the impact on revenue growth would be visible in Q1 and Q2 of FY24 actually, okay? Margins will bottom out from here on, but don't expect any massive tailwinds on margins actually.
Pandey suggests investors take a staggered approach to taking positions in the sector. Over the next 6 months, a 3 to 6% EPS cut, nearly equivalent of a 7 to 10% fall in the IT index, could provide investors with good buying opportunities at better prices, he says. That said, markets will seek direction from their global counterparts today. Besides, the Bank of Japan's rate hike decision will also be on the radar.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.